The market has priced the next Federal Reserve meeting as a non-event. 97% probability of nothing happening. No rate change, no surprise. A new chair, a new era, a formality. There's just one problem. The last 3 times a new Federal Reserve chair held their first meeting, something moved. Greenspan raised rates in 1987. The market didn't see it coming. Bernanke raised rates in 2006. The market didn't see it coming. Yellen began unwinding stimulus in 2014. The market didn't see it coming. The pattern isn't coincidence. It's almost structural. A new chair doesn't inherit credibility. They have to demonstrate it. And demonstration requires action, not continuity. So why has the market decided this time is different? The new chair is Kevin Warsh, former Fed governor, hard money thinker, someone who has publicly questioned the very tools markets have spent 20 years depending on, not in private, on the record, in Senate testimony, in op-eds anyone can find with a search, and yet the market has looked at all of that and decided he won't actually do anything. Not yet. Not at the first meeting. The consensus is so overwhelming it has become invisible. The kind of certainty people stop questioning because the question itself starts to feel unnecessary. But here is the thing about certainty in financial markets. It is never most dangerous when it's wrong. It's most dangerous the moment it starts to crack. To understand what might crack it, you need to understand something most people have never heard of, but unknowingly depend on every day. Forward guidance. Think of it this way. Imagine driving at night and someone has lit up the entire highway for 50 kilometers ahead. Not just your headlights, the whole road, visible, predictable. You don't just know where you are. You know where you're going. You plan for it. You price for it. That is what the Federal Reserve began doing in the early 2010s and accelerated after 2008. It started telling markets explicitly where interest rates were likely to go. Not just today's rate, the future rate, the intended path. And markets, being rational optimizing systems, immediately began pricing the roadmap rather than the uncertainty beneath it. Bond yields reflected the Fed's stated intentions. Mortgage rates followed bond yields. Corporate borrowing costs followed mortgage rates. Asset valuations everywhere were built on the foundation of a Fed that explained itself in advance. What markets stopped noticing is that forward guidance didn't just inform them. It became load-bearing infrastructure. The assumption of continued guidance got so baked into asset prices that removing it wouldn't just change expectations. It would change the mathematical framework through which trillions of dollars are valued. Kevin Warsh has called forward guidance a distortion. He has argued that central banks should preserve optionality, the freedom to respond to data without being locked into prior statements. The market heard this, and then decided it didn't apply. Here is what actually happens when guidance is removed or weakened. It lives in something called the term premium. When you lend money to anyone, you want compensation not just for the interest rate, but for the uncertainty of the future. For most of the guidance era, roughly 2012 to 2022, the term premium on long-term U.S. Treasury bonds was near zero. Investors were so confident in the Fed's future path that they didn't demand extra compensation for uncertainty. They trusted the roadmap. When the roadmap disappears, the term premium rises. Not because the economy changed, not because inflation changed, because uncertainty increased. And when the term premium rises on 10-year treasuries, every interest rate anchored to those bonds rises with it. Mortgage rates, corporate borrowing costs, the cost of capital for every business in America. This is shadow tightening. Policy tightens without a rate vote, without an announcement, through the bond market's reflexive demand for a higher risk premium in an environment of reduced clarity. Run the numbers on mortgages. The baseline scenario, guidance intact, neutral Fed, puts the 30-year fixed rate around 7%, an already brutal number. The housing market has been effectively frozen at these levels, transaction volumes at lows not seen since the early 90s. Add 75 basis points of term premium repricing, not catastrophic, just a modest increase in uncertainty, and mortgage rates push through 8%. At 8%, the market doesn't just slow further, it seizes. Sellers who were waiting for better conditions face the realization that better conditions aren't arriving. Prices begin to find new anchors, and somewhere in that scenario is a family with an adjustable rate mortgage resetting in July, doing the math on whether they can stay in their home. They are not watching Federal Reserve statements. They are watching rate trackers, refreshing pages, hoping. Now layer in the second mechanism, the one that receives almost no attention: quantitative tightening. The Fed's balance sheet still sits above $7 trillion. The legacy of 15 years of asset purchases, bonds bought to inject liquidity, to suppress yields, to backstop a financial system that nearly collapsed in 2008 and again in 2020. The unwinding has been slow, deliberate, careful. Under a hard money chair who has publicly questioned the scale of that balance sheet, the pace is an open question. If balance sheet runoff accelerates while forward guidance is simultaneously removed, two tightening mechanisms operate at once. Liquidity drains from the system. The term premium rises. The effective cost of money increases across the economy. No rate hike required. Not a single vote to raise the official rate. Two levers pulled from the same meeting, neither of them the one the market is watching. This is the thing the 97% probability doesn't capture. The rate decision is not the decision. The language is the decision. Every word in a Federal Reserve statement has been debated, voted on, approved. Every change from one statement to the next is a deliberate signal. And when the new statement is released on June 16th, 400 words, careful institutional language, released around 2 in the afternoon, most people watching the news will see one thing: Fed holds rates steady. They will move on. But in the fixed income desks of the major banks, people will be reading it sentence by sentence, comparing it to the prior statement, looking for what was added, looking above all for what was removed, because what was removed is the policy. If the forward-looking language disappears, the commitments, the dot plot anchoring, the conditional promises about future rate paths, then the rate decision becomes irrelevant. The non-event becomes the event. The absence becomes the message. And the bond market, patient and mathematical, will begin pricing a world without a roadmap. The consumer absorbing all of this is not in a position to absorb much more. Credit card delinquencies have been rising quietly for 18 months. Early-stage delinquencies, the leading indicator that precedes crisis. Student loan garnishments resumed for millions of borrowers after years of pandemic forbearance. Real wages, adjusted for inflation that still runs above 3.5%, have not recovered for the lower half of wage earners. The savings buffers built during the pandemic are largely gone. This is the consumer the soft landing narrative depends on. A consumer maintaining spending not through income growth, but through credit, through financial decisions that were always extensions of time rather than solutions to underlying stress. The soft landing requires financial conditions to stay stable. It requires the consumer not to face an additional shock. It requires the bond market not to reprice. It requires all of these things simultaneously, while a hard money chair takes his seat for the first time, with above-target inflation and a rising wholesale price pipeline feeding into summer consumer prices that haven't arrived yet. Each of those conditions is uncertain on its own. The compound probability of all of them holding is the calculation the 97% didn't run. Markets don't misprice things because the information doesn't exist. They misprice things because the incentive structure of institutional investing rewards being wrong with the consensus more than being right against it. The manager who holds cash and misses a rally faces career risk that the manager who holds equities and gets caught in a repricing does not face to the same degree. So the consensus holds, not because everyone believes it, because breaking from it is expensive before the moment it breaks. The people who have done the math, who have read Warsh's testimony, who understand the term premium mechanics, who have watched the wholesale price pipeline filling, those people are positioned. They are watching the clock. On June 16th, the clock hits 0. The rate won't tell you what happened. Watch the language.